Right. S&P 500 earnings are expected to drop by 7.1% in the second quarter, according to FactSet. That would be the sharpest earnings decline since Q2 2020. Can big tech companies be expected to lead in earnings growth this quarter the way they have dominated the stock market? We get our first glimpse of tech with two of the Magnificent Seven reporting on Wednesday, Netflix and Tesla. Joining us now with his earnings outlook is Dan Morgan, Synovus Trust Senior Portfolio Manager. So, Dan, thank you so much for joining us. First, let's dive right into Netflix, which was also once before it was in the Magnificent Seven. It's a FANG stock. So what's the expectation for Netflix going into their numbers?
Well, everybody's going to be focusing on the new subscriber data. The consensus estimate for the second quarter is about 1.8 million new subscribers. And then going into the third quarter, we're looking for about 4.7 million new subscribers. So those are going to be the key statistics everybody faces or focuses on. Also, people want to know more color about their Basic with Ads initiative. We think there's about 2.7 million subscribers that are on this new program that they have. So I think those will be the things everybody's focused on. As you guys know, Netflix always trades on new subscriber growth. So that's what everybody's going to be focusing on.
It does. The shares, Dan, are already up some 52% or something this year. Do you buy here going into the numbers?
Well, it's interesting because the stock trades about 38 times earnings on a historical priced earnings basis. It's traded about 75 times earnings. So from that perspective, it looks very inexpensive. But you have to bear in mind that earnings growth has slowed down dramatically. Everybody remembers Netflix, just spending tons of money on content, didn't care about free cash flow, just drive that subscriber growth. Well, that whole thing has changed. So if you look at consensus estimates going into this year, growth is only 13%. So from a, priced earnings valuation versus growth, the stock trades, slightly above where it should, but it's definitely isn't the hyper growth company that was before that was trading at 75 to 100 times earnings.
Is Netflix positioned well amid this writers and actors strike that is now upon us in terms of its content and just going forward?
Well, initially the thought process was that they had, conducted a lot of their programming kind of in advance of this, in anticipation of it. But as this situation continues to go on, it becomes more challenging, right? Because you start to get through all your shows and now you got to start new shows, especially Netflix, who's extremely reliant on, programs that go on for a very long period of time through these series. And that's how they hook people, opposed to a movie that could always be delayed. So I think initially, they were in pretty good shape. But as long as this continues to go on, it becomes much more challenging for various networks like Netflix that have to constantly come up with extensions on existing series and have writers write that for them.
And what are the Netflix margins looking like, not just here, but going into the future?
Well, their target margin is about 18 to 20%. That's what they're kind of targeting going forward. So obviously, as they start to become more focused on free cash flow, for example, in this upcoming year, they're expected to do about $3.9 billion in free cash flow. Their streaming obligation, contractual streaming obligations, about $22.9 billion. So they're definitely slowing down in terms of the amount of money that they're spending. And they're being more cognizant to margins, free cash flow, and not increasing debt so much. So as they continue to move forward, I think that you'll see Netflix become more of a margin expansion story opposed to a growth at all cost story.